Welcome to the Plan Stronger TV market update for Wednesday, July 8th. Halfway through the year, let's take a quick look at the year-to-date and last year's numbers. So you see the 2025 total return numbers there on your screen for the indices that we follow and comment on. And then for basically half the year, a smidgen more, but you can see the numbers there as well. Again, year-to-date numbers, not annualized, so you can double those numbers and give you an approximate of a full year's worth if the rest of the year is like the first half of the year, which is a big if. So standouts, of course, small caps still doing very well, but all the other major indices as well. So it's been a very strong year. So we'll bring Robert in and talk with him about does 6 months make a year, Robert, and what is going on with both the stock and the bond markets and what we're seeing happen?
Yeah, well, looking at the numbers that David had pointed out, the year-to-date numbers, one thing that really kind of surprises me is that bonds are still in the positive, meaning they're showing a positive price return. And for fixed income securities, for bonds, when prices are going up, yields are going down. You would think that, yes, because of the conflict with Iran, which kind of in the last 24, 48 hours has gotten back on again, you would have thought, especially listening to the news, that inflation is really spiking. And yes, inflation metrics have gone up a little bit in the past 2 to 3 months, but the bond market is saying something else. With that positive 0.16%, it's saying, okay, yeah, there's some prices, yields are coming up a little bit, but for the long term, we don't see these being permanent. We don't see these price increases or these price pressures staying put or getting entrenched, as people like to say. So that's kind of one thing that I take away is that the number of the bonds. So again, yields, yes, are going a little bit higher. Yes, some price pressures, but in the last month and a half, we've seen especially energy prices come down. So kind of, again, away from the media hype and looking at what the bond market is actually saying.
Yeah, and I appreciate Robert mentioning the media hype again. And we comment from time to time, and I've got a distilled comment I wanted to make on the update for you. And I think that if you go out and you look at websites or you're watching the television shows or whatever it may be, I think a big takeaway is to look at the actual financial numbers and the information, if you can kind of weed that out. And the commentary, a lot of it you need to ignore. And I won't say the name of the website I go to frequently, but I'm going there to look at the data, the numbers of what's happening. And I look at the headlines and they're completely different than what the numbers would indicate. So I'll say that just as a caution. All right, so we'll get back to the regular scheduled program now. So with that, Robert, looking ahead, do you have a couple sectors in particular that look really strong or have a lot of potential going forward? And on the converse, anything to maybe be a little careful with?
Well, first part in terms of the year-to-date numbers, going back to small caps, doing very well. And also, you mentioned the foreign stocks. We have foreign stocks are also, doing very well, almost 14%. That includes, I separate those two from emerging markets and non-U.S. developed. Last year, non-U.S. developed did fantastic, along with the emerging markets. This year, believe it or not, the non-U.S. developed, I'm talking France, Germany, Japan, those sort of things. Now, individual countries may have done well, but overall, kind of, up just shy of 10%, just like the U.S. large caps. But emerging markets have done astounding, up over 25% the first half of the year. So to answer your question, some sectors looking forward, again, emerging markets, small caps, but mid caps have kind of been subdued. Better than large caps. I think they have a lot more room to run. And non-U.S. developed, even though they haven't done that well year to date, their story isn't over as well. So my takeaway is, obviously, yes, U.S. tech, never discount U.S. tech, but at the same time, don't put all your eggs in one basket. The U.S. large caps, up almost about 10% year to date. Lot of volatility there. And you always hear me say that. What do you expect, Robert? Well, volatility, because we have an election year coming up. Just so many things. But overall, look at those numbers. If your risk tolerance says, "Hey, I can stomach 50%, 75% of equities in my portfolio," don't try to time the market, because volatility is elevated. It probably always will be, but look what happens when you're in the market and you don't try to time the market and you just stick to a plan. And yeah,
there you go. Well, and the day Robert says don't worry about volatility anymore is probably will be our signing off program. We'll be done. Okay, so that's not going to happen because it's always going to be with us, as he said. And I want to wrap up on one final question for you, Robert, and that relates to in amongst and with what you've shared, some of what's happening with these different areas of the market. One thing that we haven't talked about lately, which is merits at least a few points, and that is with precious metals, specifically gold. What are we seeing happening with gold amongst what you've described, and also what the potential outlook could be?
Yeah. Well, the outlook is,
Is there room to run?
dependent on so many, especially inflation and price pressures, fiat currencies. So many different things we could talk about relating to how it can impact the price of gold. But as far as the year to date, we haven't heard, maybe at the beginning of the year we did, but year to date, gold has kind of been lackluster.
Yeah.
So let's put up a chart. So
All right,
David's
a chart.
favorite word, chart. So this is the year to date. And what you see is year-to-date gold down 4.75%, almost 5% down. The other things you see are, the orange one in the middle, U.S. large caps, almost 10%. But then look at that light green. That's emerging markets up almost 19%, small caps up almost 21%. So, if you put all your eggs in one basket for gold, not so well year to date. But let me put one more chart up there. Let's look at 3 years now, the same securities, 3 years. Gold beats everything, up 111.3%. But look how much it's come down, and kind of another, the emerging markets and small caps, the bottom two numbers there, just under the orange, which is U.S. large caps. I believe, and a lot of others do, small caps and emerging markets have a lot more room to run. Thinking 47, 48% growth for small caps in the last 3 years, 62% for emerging markets. I think they have a lot more room to run. So the key word is, again, don't discount U.S. large caps, especially the tech sector, Magnificent Seven, et cetera. But be diversified, because so many other asset classes undervalued and a lot of potential, especially with the AI theme building out to foreign markets, emerging markets, small caps, small, mid-sized companies utilizing AI to increase efficiency, boosting their stock price. So I'm losing my breath. So that's a sign for me to, okay, stop, but diversification, really important.
Well, and you make several good points that I'd like to underline, just a couple of them. You look at gold, it's off, say, 5% year to date. Well, it's had a very strong run for 3 years. So compared to the other indices. And then you look at, you mentioned some of the tech stocks, the AI build out, you look at a stock like NVIDIA, done extremely well. And now we're seeing it, pull back. And so, all indices and all, precious metals and things like that, they all don't go up all the time. They're going to, fall out of favor. They're going to, there's going to be profit taking. We're seeing some, bumping up of some profit taking related to some of these stocks that have been in the headlines, right? Absolutely. So, we look at these things, and so we monitor it. And so the point is very well made by Robert, and the data, staying diversified really is the key of having a successful portfolio. Final thoughts?
No, I think that's all right.
Okay. Hey, look, I got to ask Robert. Just want to make sure we didn't miss anything, but often enough we've nailed it down. So, all right. So we're going to come back to you next week, and we'll help you continue to plan stronger.